Welcome, everyone. I'm Ted Earhart, recording on a Friday. We're T-minus 60 from the November election. And, every election cycle, especially in the presidential election cycles, we get the same question, and it comes in the form of, should I make a portfolio change, in quotes, because there's an election just around the corner? I say change in quotes because what people really mean is, should I get out of the stock market because there's an election? It's a great question, and I think because the current presidential race is so divisive, it might be the most divisive in modern history. It's probably not an exaggeration. I think this question is even more on people's minds this year, so we're going to spend a little time on it today. The best place to start is by going back to 2016. I want you to think about what the conventional wisdom was at that time. You may remember Donald Trump was a big underdog. In fact, people across Wall Street and all the political talking heads all concluded that Donald Trump could never be elected president. And they further concluded, especially the Wall Street folks, that if he were elected president, the market would crash. Well, guess what? Both of those turned out to be dead wrong, of course, as Trump was elected 45th president of the United States. And in 2017, when he ultimately took office, stocks had a great year. I think the broad U.S. stock indices were up about 20% in the calendar year 2017. So the point is, this is a classic example of how trying to basically play the market timing game is a absolutely foolish strategy, and far more often than not leads to worse results. There were plenty of people who jumped out of the market, in the days and weeks following Donald Trump's election. And most of those people ended up missing out on a huge rally in the subsequent month and roughly a year and a half before we experienced our first bout of market turbulence. The trouble with market timing is you have to get so many things right. And at the end of the day, that's what this discussion is all about, or that's what the question really, the underlying question really is. It's, should I try to time the market effectively? You just have to get too many things right. Think about the current election that we're in the midst and trying to somehow position your portfolio around that. Number one, you have to be right about the outcome of the election. Okay, so you have to choose correctly who is going to win. Number two, and this is probably more important, you have to predict how the market will respond to that outcome. And number three and four, which can't be lost either, you have to decide what to do with your money if you're going to pull it out of the stock market in the meantime. And then finally, you're going to have to decide ultimately when to get back into the market. So getting one of those right alone is challenging enough. Getting them all right is essentially hopeless. Of course, people get lucky once in a while, but we don't give advice around here based on hoping for good luck. Let's also talk about 2020 because there's another textbook example about why playing the timing game is such a terrible approach. Think about COVID-19, and let's just do a little thought experiment going back to January. Just imagine hypothetically that January 1st, you happen to have some special insight and knew that the COVID-19 virus was about to spread around the world. You also knew that it would end up killing hundreds of thousands of Americans, create the sharpest economic contraction since record-keeping began, and lead to the highest unemployment rate since the Great Depression. And all those things are true. Now, of course, you would have to have correctly predicted how the stock market would respond. And I think clearly, given that set of facts, anyone would guess that the market would respond negatively. Well, the market did respond negatively. We had a sharp sell-off in late February through March. But here's the thing. Within just a few months, the stock market not only recovered, it fully recovered and has gone on to set new highs as we record this today. So once again, even if you had gone to cash in January, remember the market went up into about mid-February, so you would have missed that run up. Then we saw the big sell-off, and of course we've had like I said, we've had the recovery already. My point is that chances are virtually nil that you would have had the courage or the fortitude to put all your money back to work at the end of March, right in the middle of the economic shutdown, when things couldn't have looked worse. So you probably would have ended up no better off by simply sticking with your strategy. So again, another classic example of why market timing is just absolutely a terrible course when it comes to portfolio management. Ultimately, at the end of the day, this is a broader discussion about market risk or stock market exposure. Right during the March-April time period, I spent some time going back through history, looking at the stock market in the U.S. decade by decade. And what's absolutely striking is, regardless of what decade you look at, there are always instances of steep declines, say every 5 to 10 years. And I'll define a steep decline as anywhere ranging from 20 to in excess of 50%. And I'll throw an illustration up here or some data up here, a chart to kind of validate that. But, it's just remarkable how regular these things actually occur. And yet, every time they do, people are just shocked that the stock market went down. I mean, if anything, market downturns are, I would argue, quite regular. They might not happen every year, but for sure, big downturns happen on an every 5 to 10 year basis. I mean, in fact, since Donald Trump has been elected or took office in 2017, we've seen two very sharp declines. At the end of 2018, the stock market in the U.S. declined just shy of 20%. And of course, this spring, at the onset of the economic shutdown, the stock market, top to bottom in the U.S., as measured by the S&P 500, was down about 34%. So these things are actually quite normal. And what's a challenge for all investors is, of course, everybody wants the great long-term returns that the stock market has historically offered. But at the end of the day, the price of capturing those returns is you have to be able to weather these occasional but regular severe downturns as we've described them. Anywhere from 20 to in excess of 50%. And despite the uncertainty that elections cause, what's interesting is, regardless of who's been president, the long-term trend of the stock market and even the medium-term trend, for the most part, has been exceptionally positive. Again, regardless of who's in the White House, and you can see that for yourself in the accompanying chart. So, at the end of the day, should you make a portfolio change because there's an election a couple months away? Well, if you followed along this long, I think you already know my answer. It's of course not. It would be a terrible mistake to try to play the market timing game around a future event of which the outcome is unknown, as is the stock market's response to that unknown outcome. This reminds me so much of a quote by legendary investor Peter Lynch, who famously said that more money has been lost by investors trying to anticipate market downturns than in the downturns themselves. And what he means by that can be perfectly illustrated in 2016. Donald Trump was elected. Everybody expected the stock market to collapse. People jumped ship, and the downturn never came. So people missed out on a huge run. And then likewise, even with the COVID pandemic, people who did jump out of the market this year, maybe they got lucky and jumped out ahead of the big downturn, but chances are nil that they ever got back in, and they probably weren't comfortable getting back into the market until long after prices had already covered, so they're no better off and may have ended up worse off had they just stuck with their strategy. So that's not to say you should never make a portfolio change, and it's not to say that stocks can't go down next month or next year. As we've already talked about, we know there will be future periods where there will be big stock market downturns, anywhere from 20 to in excess of 50%. That's been the historic norm. So what investors should be doing on a regular basis, election or no election, is you should be reviewing how much stock market exposure you have in your portfolio. It has to be consistent, of course, with your stomach for risk and market volatility, and it's got to be consistent with your time frame. I mean, if you are, say, 3 years out from retirement or less, and you are going to need to be taking portfolio withdrawals to support your retirement, chances are, a sizable portion of your portfolio should be positioned more conservatively, i.e. not in stocks, because you never want to be in a position where the stock market is going down at the same time you need to start taking distributions. That's really kind of the nightmare scenario. You, of course, need to do some planning to make sure you have a buffer built in, knowing that, market volatility is part of the game. You have to set your portfolio up in such a way that you can make it not only through the downturn, but to the other side of the recovery. And that's really just retirement planning and investment planning 101. So, as we've emphasized, trying to make market timing decisions based on elections and other future events is not a smart strategy. I'll just leave you with that famous quote once again by Peter Lynch. Just remember, more money has been lost by investors trying to anticipate market downturns than in market downturns themselves. So thanks for tuning in, and we'll see you next time.